Good evening, ladies and gentlemen. My name is Benjamin Goh, the head of research here at SIAS. Warm welcome to all our friends from SIAS members, as well as people coming in from the Moon platform. So right now we are broadcasting to Moon and a couple of social media platforms live. Thank you very much for joining us this evening. So what we're going to do is that the first portion, we're going to have a quick presentation, market highlights by the SGX group from my good friend Emilia Tan. She's the director of research and the FinLit group in SGX. Then after that, we're going to have a corporate presentation from AIM's APAC REIT by CEO. By Mr. Russell Ng, and after that, we're going to open it up to Q&A. For those of you who are not familiar with AIM's APAC REIT, it is a REIT listed on the main board of SGX since 2007. Its investment mandate is to invest in a diversified portfolio of high-quality, income-producing logistics business parks and industrial real estate throughout the APAC region. And the last part is actually quite important because different types of REITs have got different sectoral focus and therefore different risk factors. So perhaps you've been reading the news that there's a lot more focus on data centers. So that could be something that AIM's APAC REIT might want to elaborate on, depending on your questions. So there are other REITs like Cecile, retail, China, so on and so forth. Again, different risk factors. All right, so without much further ado, can I invite Emilia to kick off the evening with the market highlights from SGX. I'm sure she's got a lot to say since the market has been going a bit berserk nowadays. Over to you, Emilia. You're on mute. Yeah, okay.
Hi, everyone. Thanks, Ben. Sorry, I was trying to adjust. Okay, you guys can see my slides, right? Thanks for having me this evening. A quick update on the Singapore market, like what Ben said. Disclaimer that whatever you see is more for education. Past performance may not indicate future performance. And then move on to the first slide. I think it's almost going to be the second half of this year very soon to come in 2 weeks' time. We do a bit of a recap of where the Singapore market is, especially where the Straits Times Index, which is the benchmark for the Singapore market, where we are at the moment. So the SCI currently is within 2% away from its all-time high, which was over the 4,000 levels. In fact, today when I took a look at it slightly earlier before lunch, STI, the Straits Times Index, was at around 3,920 levels. So we're just about 2% away from its all-time high. When I look at the Bloomberg 12-month consensus estimates, the analysts are expecting, or rather the street is expecting the STI to be at around 4,265 levels. STI has rallied significantly in the recent years, especially in the last 12 months. But I think when I pulled the number, STI returned about close to 23% in terms of total returns over the last 12 months. So very, very strong returns, in fact, breaking a 17-year high. However, when you look at the valuations, or from a valuation perspective, using the price to book ratio, the STI actually trades at a price to book ratio of 1.3 times. This is relatively undemanding, and it's well below the 2.5 times seen back then in 2007. The chart that I wanted to show on the right that you see over here, will walk you through. The point to bring across is when we took a look at institutional investors' fund flows from that perspective, we noticed that there were periods where the STI had outperformed, for example, in the two boxes that I have boxed out over here. During periods where STI outperformed, institutional investors have actually been net buyers of the Singapore market. For example, when in 2022, we saw STI being the world's best performing index, institutions actually net bought over 700 million Sing dollars. In second quarter of 2024 up till the end of last year, we also saw institutional investors accumulating over 830 million as the 12-month consensus estimate target price for STI climbed from 3,600 levels to close to almost 4,200 levels. And the point to make also that I wanted to bring across is that despite seeing all these headline numbers where we talk about net institutional flows, inflows or net outflows, usually this net number is derived from taking the total buys minus the total sell. So if the total buy exceeds the total sell, it means that there are net inflows, more buyers than sellers. If it's on the other side where there are net outflows, it means that that the buying activity is higher than the selling activity is higher than the buying activity, therefore net outflows. So despite us recording, in 2024, net outflows of about 300 million, and also the earlier 2023 institutions net sold the Singapore market at a cost amounting, I think it was about 4 billion, which is the line that you see over here. Net outflows in 2023 amounted to $4 billion worth. However, when we take a look at the total buy and the total sales, it shows that institutions across the board are very active. For example, despite the net sell of 4 billion in 2023, there were close to about 115 billion in institutional buys and 119 billion in institutional sales. So institutions have been a big player in the Singapore market, right? And then brings us on into the next slide, which is what about retail investors and the retail segment? Actually, when we take a look at the fund flows in the retail segment, they tend to be lesser, smaller scale in nature, but it tends to provide us with a little bit more insights as to what retail is actually buying and selling. And usually across the board, the total retail buys and sells are usually 2/3 less than for institutions. Recent trend shows that during the dip, or when as the Singapore market dip, there actually has been more retail buying activity during the moments of dip. So perhaps retail investors are quickly rotating into Singapore stocks during periods of volatility, and especially towards the tail end of market pullbacks. Perhaps retail investors looking for opportunities and also buying the dip. Now, from the three charts that I have over here, a couple of key points that I wanted to bring across the board. The first one on the left, it shows that as we see the STI performing over the last 5 years, retail has consistently been buying and selling throughout, whereas the earlier chart we saw, institutions have generally been net selling from the Singapore market. The middle graph over here, it's, over the last 5 years, retail has actually net bought a lot of Singapore stocks. In fact, retail has net bought close to over $16 billion worth of Singapore stocks, right? And the graph on the right was that when the banks declined about 13% in early April, this actually prompted retail to net buy a total of $1.5 billion worth of bank stocks. Therefore, retail coming in, perhaps taking the opportunity to buy the dips. In this slide, I want to talk a little bit more about some of the stocks that were most net sold by retail. So when we took a look at the data back in May, there were actually 25 stocks that saw retail net selling during the month of May. And these 25 stocks actually averaged 9% from a total return standpoint. So with retail being active net buyers of the Singapore market, there were also times, of course, that retail investors were net sellers, and during May, we saw that. And despite the top line flows indicating that retail net sold these stocks that actually outperformed their peers and indices, perhaps indicating that retail investors were profit taking. And on the flip side, they were net buying stocks that have underperformed. So perhaps value buying. And of the 25 stocks that retail net sold during the month of May, 11 of them were STI counters. Some of the names are in this table that you see over here: SIA, DBS, Keppel, Singtel, UOB. And on the other hand, some of the non-index stocks that retail actually made that sort of trade were in stocks such as Sheng Siong Group, SIA Engineering, Fraser's Hospitality Trust, Franken, and also UMS. A key development in the Straits Times Index, which was announced earlier this month, was that Keppel DC REIT will be entering the index, replacing Jardine Cycle and Carriage, starting from, I think, close about next week, 23rd of June. Keppel DC REIT actually will be rejoining the STI after they left the index in 2023. Keppel DC REIT is a pure play data center REIT. They've got a market cap of close to about 4.9 billion. They own data centers across 10 countries, including about 2/3 of its portfolio in Singapore. And as we know, data centers have been a popular asset class given related to AI boom. You see that investors are probably valuing the REIT with a price to book ratio of about 1.4 times. So with that inclusion coming the end of the month, this will bring the number of REITs in our Straits Times Index to 8, and likely we will see the total index weight of REITs being perhaps over 10% when the change happens, right? And next, we take a look at the Singapore REIT market, looking at the different subsegments, how they have performed so far. The data that I have over here is on a 4-month to date basis ending April this year. Just a quick highlight and then recap as to what happened across the different segments. Best performing segments in the market so far this year for REITs have been healthcare, followed by retail and also diversified REIT. And this reflects very much in the fund flow movements. If you take a look at the two graphs on the right, the top sort of institutional flows are also the same three: healthcare, retail, and also diversified is number 4. Specialized was the third. On the other hand, we see that the retail investors have actually been net selling the top performing segments. And again, like what we mentioned earlier on, perhaps profit taking. Healthcare, generally across the board, healthcare has been a defensive segment for the REIT market. They've been one of the better performing ones over a 2-3 year basis. Retail REITs, we see that domestic assets are a little bit stronger, rising, perhaps riding on the consumer spending trend, tourism trend. Diversified REITs within the sector, returns were generally mixed, but the resilient ones were some of the larger ones with stronger domestic exposure. They had outperformed. For the hospitality segment, generally you see that we are recovering year on year because of better operational metrics, riding on higher tourism, momentum, so on and so forth. That we're seeing improving room rates, better occupancy rates. In the office segment, bifurcated, domestic assets are seeing stable fundamentals. Overseas assets continue to see sustained pressure. Industrials, which is what we hear a little bit more today from AIM's APAC REIT. Industrial REITs as a segment appears to be in an uptrend when you look at the performance this year so far against last year. Uptrend, a couple of drivers. What we're seeing is that occupancy rates has been strong, positive rental reversions, and also supported by e-commerce and broader pickup in growth overall. Specialized, which is the data center REITs, a little bit of what we talked about for DC REITs. DC was a best performing subsegment in 2023, but of course, last year, but it gave up some of the returns that we've seen, perhaps investors profit taking. Fundamentals are still strong, considered a defensive AI growth-oriented sector. With that, how are REITs trading? Right, a quick one. When we took a look at where REITs are trading from a price to book standpoint, the S-REIT index actually trades at a price to book ratio of 0.8 times. So this is below the -1 standard deviation, and across the mean, it's trading at close to about 20% discount to its longer term average. And some analysts are also seeing that where REITs are today could be at the bottom of the cycle, and we could see some of the reversal of that buy bank sell REITs trend, which has been playing out over the last 1 to 2 years. Especially so because if REITs are trading at a 20% discount, banks, how are they trading from a price to book standpoint? We last took a look at it. It's on the high 1.7, 1.8, 1.9 times. So therefore, perhaps rotating out of the banks and into the sort of undervalued segment, which is perhaps a reason why we saw retail investors net buying REITs, net buying close to $4 billion worth of REITs since 2022, right? And my other chart over here, which actually plots all our 40 S-REITs and property trusts from a price to book ratio standpoint against the 4-month 2025 total returns. Point over here is that the index REITs, they tend to maintain higher price to book ratios within the sector. The ones that you see perhaps on the top right-hand corner, probably what you would see consider as outperformers, and they tend to trade at higher price to book ratios. But overall, there's value for investors. Majority of the sector actually trades below book. And at this point in time, I think when we took a look at, we just had about 7 REITs that are trading above the 1.0 times price to book ratio. From a distribution yield standpoint, because investors, when they buy REITs, of course, they look for dividends, distributions, right? This is a graph that we have plotted the distribution yields across different subsegments. healthcare specialized REITs, they are generally paying the lower distribution yields, but then also recall they trade at higher PB ratios. On the flip side, the opposite is also true. Office, hospitality, generally one of the higher segments for distribution yields. From a valuation standpoint, they are also on the lower end. My last slide for this evening, this point, we took a look at all our different REITs, the gearing ratio for all of them. Conclusion over here is that S-REITs are still maintaining healthy balance sheet strengths. The sector across the board, on average, gearing ratio is under 40%, at about 39.6%. This is still below the 50% regulatory limit. And more than half of our REITs, when we took a look at that, are actually trading below the sector's average gearing ratio. And also, of course, not to mention, amidst the higher interest rate environment over the past couple of years, close to three-quarters of our S-REITs debts actually were entered into fixed rates. And this is sort of a way for them to sort of hedge their interest rates amid a higher interest rate environment. And last slide would be a QR code that you can follow us on Telegram for more daily market updates on the Singapore market. Thank you. Ben, over to you, please.
Thank you very much, Emilia. So very interesting presentation about how REITs are undervalued from a price to book perspective, and therefore the average yields are quite mind-boggling, right? 6.9%.
6 to 7%.
6 to 7%, and then you might factor in another few percentage points for upside price return. So that is, as they say in French, more than 10% total return. Wow. Okay, and we're not talking about Nvidia here. So yeah, good story for the REIT sector. So thanks for that. The next segment, I want to warmly welcome the senior management of AIMS APAC REIT. So definitely a focus of the discussion by Emilia, in Emilia's presentation. So I want to welcome the Chief Executive Officer, Mr. Russell Ng, as well as the Chief Financial Officer, Ms. Joo Lee Lim, to join us. They're going to be giving us a 20-minute or 25-minute presentation on their REIT, and then we're going to open up to Q&A. So Russell, very warm welcome. Thanks for joining us this evening.
Great. Thanks for the introduction, Ben. I think that was an insightful presentation by Emilia. I was obviously watching very closely the industrial performance. I saw there was a negative 11% for the year. I think we managed to have a pretty good FY 2025 performance. So look, happy to share through really the key highlights of our business, really the focus strategy, and also just to take any sort of Q&A towards the end to be a bit more productive. Thank you.
Okay.
Great.
Yeah, I think I can just leave the next segment in your good hands and just kick it off whenever.
Fantastic. Thanks, Ben. Okay, look, thanks everyone for joining us this evening. Today I'll be covering a brief overview of the business. Who is AIMS? Who is it sponsored by? We'll talk a little bit about our track record over the past 5 years. And sort of go through key highlights across the portfolio, capital management, and sustainability components. Okay. And look, just a quick background for those that may not be familiar. So AIMS APAC REIT is sponsored by AIMS Financial Group. The group is headquartered in Sydney. They've got a 30-year history. They're involved in various sort of financial services businesses, starting from mortgage lending all the way to securitization and funds management. Over the years, AIMS has raised over 4 billion from the capital markets. It's originated close to 9 billion in mortgages. As a result, the group has a lot of experience, navigating through different debt markets. And the group has also invested in over $3 billion in assets across Asia Pac. Now, in terms of its businesses, it's acquired the Sydney Stock Exchange in 2008. In 2009, they took over the MacArthur Cook Real Estate Fund platform, of which AA REIT actually sat under this particular platform. In 2010, they actually partnered with AMP Capital, which is one of Australia's pension funds, and sort of bought AMP as a 50-50 venture. And in 2019, AIMS acquired AMP share and is now the full owner of AIMS APAC REIT Management. Now, AIMS APAC REIT, or A REIT as we like to call it, essentially is an industrial REIT, essentially covered across logistics and warehouse. So these are properties that are leased to the likes of DHL, Siva, Schenker, Li & Fung. We've also got 3 business park assets, 2 large business park estates and campus in Sydney. We have 1 also in Singapore. High tech for us is really in a mix of R&D production. And in this case, it's really, it's utilized as a life science facility, and industrial. Industrial covers quite a wide segment from advanced manufacturing, food facilities, as well as data centers. Now, in terms of the portfolio construct, we've got the bulk of our portfolio in Singapore, more than 70% of our portfolio value, 25 properties, now 24. We've just sold 1 asset and announced it this evening. But this is where most of our leasing activity happens. This is where most of our asset enhancements and redevelopments also take place. We've got 3 master lease properties in Australia. So 2 business park assets and 1 industrial property in Queensland. And the balance WALE was about 5 to 7 years. So fairly long WALE profile. So the way we see it, the Australian properties really anchor the portfolio income distribution. They've also got rental step-ups every year by about an average of 3%. And our Singapore properties is where most of the leasing happens, where we have mark-to-market opportunities, as well as the asset enhancements and redevelopment. Now, what really differentiates AIMS APAC REIT from our peers, I would say, is we've had a very long history in undertaking value-add activities. And so what that means for us is a combination of asset enhancements and redevelopments. Now, for us, when we look at asset enhancements, we really spend a lot of time, finding ways to extend the floor areas, maximizing plot ratios, or really focus on having targeted asset enhancement works in order to attract a very strong quality customer to the property for typically a master or anchor lease that can go from 7 to 15 years. So if you look at all the past cases from Optus Centre to 29 Woodlands to 23 Tai Seng, these are examples of properties where we've actually undertaken a strategic upgrades in conjunction to a discussion about a lease extension with incumbent master tenants. And that has really led to not only higher rental rates, but also rental escalations, a very stable income growth profile over 10 to 15 years, and has also resulted in significant valuation uplift upon completion. We're also at the moment undertaking 2 asset enhancement projects, 1 at 7 Clementi Loop, 1 at 15 Tai Seng. For the case of 7 Clementi, this is really a repositioning of an old warehouse. This will be upgraded to a Green Mark Gold certified building. And that's really been sort of focused to meet the requirements of a global storage company who have signed the lease for 15 years. We've also undertaken a progressive upgrade at 15 Tai Seng, and that's a progressive upgrade through the building. We've also, as part of the repositioning strategy, looking to transform this industrial property to more of a high-tech type tenant profile. And following the feasibility and the schematics, we were able to attract a Temasek-backed advanced manufacturing customer who is involved in aerospace and technology for a 10-year lease. And that's not only at a higher rate, that's also coming with rental escalations over that period of time, and therefore really sort of supporting that asset enhancement strategy. So that's really our bread and butter. This is what's really helped us really maintain a very strong operating performance and very resilient financial earnings. Supporting the asset enhancements, we've also undertaken 6 redevelopments over the past decade. We've built close to 2.8 million square feet of new space. Of the 6 projects, 4 of them have been ramp-up warehouses. And that's been really good for us because typically we have a ramp-up property. The demand from customers have been pretty strong. And so most of these properties have almost been fully occupied since they were built. Other than a small sort of transitionary period when you sort of go from a master tenant at 20 Gull when it was first completed into a multi-tenanted property, the properties have always been fairly well sought after. And that's what's really been sort of driving a lot of our rental reversions, so which I'll cover a little later. We've had a very strong rental reversions really over the past 3 to 4 years coming from the ramp-up warehouses. We also have 2 built-to-suit projects. One is for a food distribution company, and one's also for another advanced manufacturing customer who's involved in the healthcare space. Again, supplementing the organic growth opportunities comprising asset enhancements and redevelopments is really acquisitions. Now you can see through this time bar, we don't acquire every year. We're not a serial acquirer. We take our time and we try to balance it. So in years where, for example, the last 2 or 3 years where there's been higher interest rates, we focus our time and effort more on the organic growth opportunities because we saw a greater opportunity to have a high yield on cost, return on investment. Particularly when interest rates were higher, you get a much tighter yield spread, and therefore your accretion benefit is also relatively limited. So in the current environment where we see interest rates on the downtrend, we think there's going to be great opportunity for us to hopefully acquire a nice asset that is not only accretive but also provides us hopefully with medium to long term enhancement potential. Now, if you look at our metrics, we're very selective. We look for not only modern specifications, we spend a lot of time looking at the credit profile of tenants. It needs to be typically financially strong profile customers. We're looking at lease profiles that have that rental growth ability, either through inbuilt escalations or potentially a mark-to-market opportunity. And we saw that for 7 Bullen. We acquired this during COVID 2020. We renewed this lease last year. And so when we acquired it, we were very comfortable that we could renew this property for a further 5 years at an improved rental rate. And we also look at the infrastructure within the precinct, because that's also going to be very important. That determines the underlying land value of that site and, of course, future value add potential. Now, the one thing I would say here, if you look at the past acquisitions, in the case of 56 Serangoon, we've actually entered into a master lease conversion. So we've actually brought in a master tenant, converted this into a master lease, triple net. That's really given us very good stable income. For 23 Tai Seng, we've upgraded this into a data center in the previous slide, as you can see over here. And that's a Green Mark Platinum building with a very captive tenant. 30 Tuas West Road, we've actually knocked this down and we've actually redeveloped this into a ramp-up logistics property that has been very well sought after by customers. And so if you look at our 3 Australia properties, the thing that you can see in the 3 pictures is they all sit on very large land plots. And for us, that's been an important feature of it because we're not only looking at receiving income today, hopefully in the future, there's an ability to potentially redevelop the site and maximize the plot ratios. In the case for Optus, what you don't see in this picture is all around Macquarie Park, there's been significant infrastructure investments. The government's actually putting a lot more capital, pushing out more residential towers, both in Macquarie Park and Bella Vista, where Macquarie is. So you're going to see the underlying land value increase over time with the increased infrastructure within this precincts. And this optionality that we see is not captured in the valuation. The valuations are typically valued based on the income cash flows from the tenants, but we see a potential upside from these properties over the longer term. And similarly for Boardriders, when we acquired the site, it was a 12-year lease with a very nice rental yield. Again, we see that as potential redevelopment site, given that it's actually located just 2 doors down from a regional shopping mall, and it's also got water views behind as well as residential nearby as well. And so over the years, you've seen we have built a portfolio gradually through a combination of acquisitions and value add organic growth initiatives. And that's really sort of given us a very nice sort of stable growth profile. And since AIMS took over, our portfolio has grown 4 times from $500 million in 2009 to $2.1 billion today. And the market cap has also grown from 60 million market cap in 2009 to over $1 billion today. And as a result, we're now included in several REIT indices, which is important because it does give you greater institutional capital visibility. Now, I'd like to sort of cover this slide just to give a sort of backdrop. With all the works that we've undertaken over the years, That's really allowed us to really have a consistent year-on-year top-line revenue growth, top-line net property income growth, which has also translated down to distribution growth to unit holders. And so, distribution to unit holders also includes, really our capital management initiatives, managing our balance sheet and our hedges so that we can sort of, navigate, rising interest rate environment. But that's also, we've been able to achieve consistent year-on-year growth, and also, obviously clearly down to DPU, which is a key feature for us. So we've had that growth on a year-on-year basis. We did see that drop in FY24, and that's because we had the equity fundraising of 100 million. But then I think this year we've actually, saw that increase back to 2.6%. So overall, a very consistent, resilient set of performance, really backed by proactive asset management as well as our capital management initiatives. Now, if you stretch out the performance over a longer term for the past 15 years, you can see here that AA REIT has also outperformed the Straits Times Index by about 154%, and also the FTSE REIT Index by 176%. I think importantly, AA REIT does provide a very strong dividend yield for about 7.6%, which compares very favorably to the 10-year government bond as well as various indices. And I think it's also higher than the average industrial REIT index that Amelia had shown earlier of 6.6%. So again, a very attractive yield, and we've been able to sort of manage the yield around these levels consistently and sort of growing that progressively as well. Now, just touching upon a bit our key highlights, how we've been able to achieve that sort of steady performance year-on-year basis. We've got a pretty balanced portfolio. As I mentioned earlier, the bulk of our assets are in Singapore, 24% in Australia by revenue contribution. Now, almost half our portfolio is coming from the logistics and warehouse segment, which has been doing very strong. And that's because there has been a bit of supply-demand imbalance. And given the fact that we've got a high proportion of our portfolio in ramp-up properties, we've been able to really sort of drive rental growth as well as maintain occupancy at a reasonably high level as well. In terms of the lease structure, it was also fairly well balanced. We like the fact that we've got 58% multi-tenancies. These are typically shorter dated leases, which allow us to mark to market and also benefit from rental reversions versus the master leases that give us a very sort of stable rental growth on a year-on-year basis. Now, if you look across our leasing, typically every year we have about 20% of our portfolio that expires. And one thing that we've been fairly proud of is we've been able to not only renew that 20% every year, we've been able to achieve, as you can see, pretty strong rental reversion. Last year we had 24%, this year 20%. And what's leading that? The logistics and warehouse segment, which I mentioned earlier. It's really sort of due to the high specifications, the location, as well as the ramp-up nature of those assets. If you look at the lease expiry profile going forward, again, we've got 20% coming up in FY26 and fairly well balanced. So that's really going to be business as usual for us. But importantly, we have a portfolio WALE now of about 4.4 years. So I think that's probably one of the longest WALEs amongst the industrial REITs, which again has been a great result for us, given the fact that we've got quite a number of multi-tenancies renewals that have taken place. So achieving that level, lengthening the WALE and keeping between 4 to 5 years, I think has been a fairly good result for us. Now, what really underpins the distributions for us as well has really been the quality of tenants that we have in the portfolio. As you can see, our top 10 tenants really are from leaders in their respective industries. Woolworths, Optus, that's owned by Singtel, Illumina, it's a leader in DNA genome testing, US life science company. You've got KWE, a pretty large Japanese 3PL and freight forwarder. You've got Schenker, you've got ResMed, a leading developer and distribution of sleep apnea devices. They've got more than 50% market share. These are high quality customers, and they really underpin the distribution performance. So when we look at not only asset enhancements and looking to attract anchor and master tenants, we do really seek out quality customers. as well as when we look to acquire new properties, we also spend a bit of time to underwrite the financial profile of those tenants that come into the portfolio. Now, capital management's also been an important strategy for us in the last financial year. Look, our tagline is cushion for volatility, position for opportunity. As I mentioned earlier, we did a fundraise back in FY24. We thought the market was a little uncertain, and we also had this upcoming asset enhancement projects in the pipeline. So we took the opportunity to really just balance, manage the balance sheet, and also ensure that we have the funding in place to go and pursue our organic growth opportunities. But with a current low gearing of 29%, that gives us significant flexibility. I think we're the third lowest. I think with the REIT, we may be the third or fourth lowest gearing. So that gives us hopefully a nice headroom to go and pursue a good DPU accretive acquisition. Now, last year as well, we managed to seal a new unsecured sustainability-linked loan facility. Now, what's important for this structure is that we went from a secured financing arrangement into an unsecured arrangement. So that gives us more flexibility as we grow the portfolio. We're kind of standardizing our financing structure, which allows us to access not only lenders, but the bond market. But the second part of it is we overlay our sustainability KPIs, which give us additional interest savings if we meet those KPIs. So it's a double win for us. We also issued a $125 million perpetual security just before the tariff trade war commenced. And that was done pricing at a very attractive rate of 4.7%. And at this particular level, upon redeeming our existing perpetual in August, the savings are immediate. You'll get about a $1.2 million per annum saving over the next 4.5 years by just having that proactive issuance of the securities. So it's been a very good year for us on the capital management side, and that's been a really important feature because having that balance sheet, again, allows us to navigate market volatility and also be on the lookout for opportunities in terms of acquisitions and other growth opportunities. What you can see over here is we've also managed to stagger our debt maturity profile. That's also quite important for us. We've got no debt maturing in FY26, and a weighted average debt to maturity is 3 years. On the hedging side, again, we take a pretty conservative approach, but typically our hedges go from between 60 up to 90%. We're currently sort of hedged about 90, so about 85% in the moment on interest rates. And in terms of forward currencies, we hedge about 74% of our Australian distributions just to give us some stable sort of income coming through from that market. So moving through to sustainability. Sustainability for us has been, again, another focus really over the past couple of years. The way that we think about sustainability is having, using sustainability as a competitive advantage. And so how do we not only get the benefits of reduced carbon emissions and ESG benefits, but how do we get commercial benefits coming through the portfolio? And so some of this could come in the way of reduced operating costs, or in the case of our solar projects, we're able to sell excess solar energy to the grid to generate incremental income for REIT unit holders. Now, importantly, this year, we did also align at the start of the year. We had 3 key targets that we workshop with the banks. And essentially, the first one is to reduce carbon emissions. We have a long-term target to reduce carbon by about 42%, to increase solar energy capacity, and also to have a high proportion of green leases with our tenants. So this will essentially require our tenants to use green and sustainable fit outs and materials as part of their leasing requirements. So that is really sort of on track. We should be able to provide further updates to unit holders once we've done completed the full audit. But I think importantly as well, in terms of meeting these particular strategies, we've commenced our phase 2 solar project. We've done phase 1. Phase 1 was for 6 properties. That was giving us close to 10.8 megawatts. Phase 2 will give us an additional 3.6 megawatts. So this is really quite substantial. We're probably one of the largest amongst Singapore REITs. And if you think about the capacity, it's enough power to generate over 5,800 three-room HDB flats for a year. So really quite substantial, and this would be for the next 15 to 18 years, so 15 to 20 years, based on the actual useful life of the solar panels. And really, just to end off the presentation, the way we look at this business, we call it the four pillars. It's really just very focused strategy. Whether it comes to investments and developments, we don't invest every year, we don't develop every year. We kind of time it, and we kind of try to complement that with organic growth to give us a very sort of smooth, gradual improvement in net property income. Active asset management, really for us, that means taking a very proactive approach to leasing. We've had a very strong leasing outcome over the past few years because we've got a very strong team, and also very strong tenant relationships. And you couple the asset management side of the business really with the capital management side, and that's really having a very strong balance sheet. It's having a good risk management strategy in terms of hedging strategy and cash management. And then you complement that with strategic partnerships. And for us, that really means finding the right anchor and master tenants for our properties, as well as potential capital partnerships for new investments. So with that really ends the presentation. Hopefully that was informative.
Thank you very much, Russell. So that was great. We do have a couple of questions that were pre-submitted, as well as some which are coming in from the Q&A function in Zoom. I think I'll just kick off with the pre-submitted questions first. All right. So let's start with the macro, right? So given the backdrop of Donald Trump's ongoing tariff war against friends and foes alike, what is the management strategy game plan for AIM's APAC REIT for the next few years?
Look, I think firstly, we did a initial study really for our top 20 tenants that make up 2/3 of our portfolio. And the question was, how much of their business are being affected by US tariffs? And I think the answer was less than 10%. And I think that's qualified by saying it's not the whole business. It's maybe a portion of the business that may trade to the US that may be affected. But at the moment, we haven't seen any direct impact on the portfolio. So we are very much monitoring over the next few months to see whether there has been any slowdown because of the uncertainty. There might have been some pullback in terms of demand. Now, that being said, I think this immediate sort of headwinds presents longer term opportunities. Because when we speak to some of our tenants, for example, I spoke with one of our master tenants. They've got a factory in China. They build semicon components, and so they ship it to Singapore. They repackage it. They've got actually a whole shelf of rare earths. And they're saying this rare earth shelf is going to be worth more than gold. But they see Singapore certainly benefiting over the medium to long term, because they do export a lot of their components over to the US, including companies like Apple. And so their feedback is, I think we will benefit over the medium to long term, but in the short term, there is that decoupling and that supply chain dislocation. And that's affecting the input costs and the ability to source some of these components to help their business. But I think in the long and short of it, I think Singapore as a country should benefit as a reliable trading partner. Singapore's also got very good sort of trade and tariff arrangements with the US relative to its peers. If you look across ASEAN, most of our neighbors have a tariff rate with the US ranging from 20% to 40%. And Singapore's got 10%. So I think it's got the right sort of components going for it. And certainly, if you look at some of the big drivers of industrial demand in Singapore, where is it coming from? It's coming from the semicon manufacturers. In fact, we are aware there's been close to about $30 billion US of investments. If I count from 2024 up to 2028, they include the likes of Micron. There's a TSMC joint venture. And so we don't see these tenants in our portfolio because they typically go to JDC, they get their own facility, but there'll be downstream supply chain requirements.
Right.
So I think in long and short, uncertain period, but I think headwinds can potentially become tailwinds, if things hopefully sort of pan out the way that we hope.
Okay. As a follow-on to the previous question about tariff war, do you see or rather, how do you see the current economic environment impacting your REIT's ability to do rental reversions?
Look, I think at the moment, we've had almost 3 to 4 years of positive rent reversions. Starting with 8% 4 years ago, 18%, 20%, 24%, 20%. Most of our leases are typically 3 to 5 years. So I think with mark to market, the bulk of our leases. That being said, I am hoping to try to achieve a mildly sort of positive rental reversions this year, in terms of low sort of single digit levels. So that's barring any sort of major pullback by the industrialists and potentially lower demand. But at the moment, our occupancy now is tracking on a committed lease basis close to about 96%. We've managed to keep occupancy between 96 to 98%, which is for us almost structurally full. There's going to be people that move in and out. But certainly we haven't seen any impact, and we are just monitoring the market at this moment.
Okay. Focusing on your comment about the occupancy, your aim is to have occupancy rates between 98 and 96%. Coincidentally, there is a question coming in from one of our online viewers. So the occupancy has dropped from a peak of 98.1 to, I guess, 93.6, but that's probably not counting the committed occupancy you talked about just now.
That's right. That's right.
Yeah.
Yeah. Because we have also the one asset enhancement that we mentioned earlier. So that 7 Clementi, we actually decanted all the tenants in order to undertake the repositioning works.
Oh, you kicked them out? Okay, that's great.
Yes. So the income hasn't come through yet. So that income will hopefully come through. It will come through the next financial year. So you'll see that benefit, sort of supplement some of the rental reversion outcomes as well.
Cool. All right. So it sounds like the quota number of 93.6 is kind of a temporary, moving in, moving out kind of phase. Yeah. All right. So that's great. Okay, cool. All right, there's a question here about interest rates, so in the worst case scenario of interest rates being maintained for higher for longer, that's the mantra. So what is the game plan for AIMS APAC REIT to handle higher for longer? And also related to that would be your perpetual securities, because that was secured at a interest rate of 4.7%, right?
Yes.
Yeah. So how does that fit into the picture?
Maybe I take that. Yeah.
Yeah,
Okay.
please.
Hi, Joo Lee.
Jump in.
Hi. I think for us, it's always the strategy for us is prudent and proactive capital management. We don't wait until the last minute. Now we know that US Fed probably they're going to pause this year. The likelihood of a rate cut may be slimmer. For us, if you look at our history for the past 2 years, our hedging has been more or less about 70% handle to about 80% handle. We are guided by certain board criteria and risk management policy that we have to hedge at a certain level to maintain the optimal level to give a certainty to the distribution to the unit holders. Now, as it is, when you see our hedging, we are about 85% hedged. We also started to do, for the past few years, forward hedging strategy that will give us the benefit of protecting the DPU that is in the future. So we do some short-term forward starting interest rate swaps to give us that level of protection. Now, so these are the things that we do. Having said that, we are not only looking into protecting the interest rate. You mentioned about perpetuals as well. As part of the capital mix, we have perpetual security. So we are proactive in terms of when we do the 125 million issuance of new perps at 4.7%. That was just a few days before the Liberation Day. So we wanted to make sure that we are protected in the sense that we are not bound by a lot of risk market factors, lack of liquidity in the market, rising interest rate. That's why we are prudent. We want to capture that narrow window opportunity to give us certainty when we redeem the perps in August 2025. The redemption will happen to replace the OPERPs carrying a distribution rate at 5.65. So when we issue at 4.7%, like what Russell mentioned earlier, that will give us an interest saving of 1.2 million on a per annum basis. So overall, holistically, it's always proactive monitoring of a window opportunity in the market, because we can see that market are now becoming more and more volatile, and the cycle is shorter and shorter.
I must, compliment you on your mastery of the technical details. Were you a fixed income banker in your previous life before joining as a CFO? So, but
Well
that's,
trained, huh?
by far kind of the best CFO answer I've received when it comes to funding so far.
Thank you so much.
So thank you for the color behind that.
Yeah.
And that actually answers quite a few of our questions that we've had coming in as well as online. Okay, let's see. Okay. So let's talk about data centers. So you have at least one data center in your property, right? And then the whole buzz right now is on NVIDIA and perhaps AMD with their new chips coming online. So do you see a higher prevalent demand for data centers? And what is your REIT's strategy to capitalize on that? Or do you think it's a fad and not too interested? Or where do you stand on that?
So, okay, look, we have one data center in the portfolio. We have considered converting other properties in the past, but I think Singapore, the authorities actually had set of moratoriums.
Yeah.
So we actually pivot from that particular strategy. And actually, one of the properties that we were considering was 15 Tai Seng, the second property that we had just upgraded fairly recently. Now, from a data center strategy perspective, it's a fairly technical and specialized area. And so in order to access data centers in this market, you really got to go from the ground up. You either convert an existing property or you develop from the ground up. And typically, you do need to sort of work together with an operator because you need to really sort of define the technical requirements prior to sort of applying for power capacity at the respective properties. We do have a few properties in Australia, and I can just share with you just quickly the two properties in Sydney, Optus and Woolworths. So Optus Centre is located in Macquarie Park. There are actually quite a number of data centers in this precinct. And so, longer term, could that be a data center development? We would love to, but I think at the moment we've got almost like 7-8 years remaining WOW, so it's a fairly long time away.
Yeah.
For Woolworths is also quite similar. There was the Reserve Bank of Australia data center across the road. There was also Commonwealth Bank of Australia data center nearby. IBM had a data center also within the precinct, and they just sold it to a new data center platform. But the good thing about Woolworths is that it sits on a 90,000 square meter piece of land. The building itself is only 44,000 square meters. And actually, I guess it's hard to really appreciate the scale of the site, but there's actually a huge component on the left side. And we're looking at ways, can we maybe carve out part of that site in order to do something, right? Be it data center, be it a service residence. There could be something more that we could do. So it's something that we're exploring. But again, this property, the WOW's got a fairly balanced WOW of about 5 to 6 years. So it's still got some time away. But we're certainly just exploring and just thinking about feasibility. Can we do something on these sites? Now, in terms of new acquisitions, having looked at past data center properties, they've typically traded at a very low cap rate, anywhere from 4.5% to 5%, and so you don't get that yield spread. So I think to really sort of access that market, you've got to go in and sort of develop on the ground up. So we will selectively, I guess, be opportunistic in this space. For us as a group, we're not so tied up solely with data centers. So certainly there's that secular trend of data centers, and I think that's growing over time with AI. But for us, we do have a lot of tenants in that manufacturing space, that component space that provides the picks and shovels. So, we can still benefit from data center demand, so AI demand, indirectly through some of the advanced manufacturing profile customers.
Okay. That's a great answer. And yeah, the car park over there could probably develop in a couple of years, can squeeze out a little bit more yield from that.
Exactly.
Okay, there is two questions here on corporate action. So, what are your plans for future acquisitions or any kind of additional equity fundraising, either in 2026 or 2027? And of course, for folks out there, management team obviously cannot divulge any kind of insider information. So, yeah, so maybe just some background color.
Sure.
Yes, strategy around that.
Yeah. And so if you look at this slide, I mean, this is a great sort of segue. We have, if you look when we started, 2009, 2010, we had a 4-year gap before we did anything. 2014 to 2009, we had a 5-year gap. And we bought 2 properties consecutively in 2020 and 2021. And we're now 2025 having that 4-year gap. So it's about that time. And as I mentioned earlier, our gearing's at about, just under 30% as of financial year end. So we are looking for opportunities. We are, I would say, agnostic to Australia or to Singapore, because at the end of the day, we are looking for assets that meet really all these criteria. And it's not easy, because when you're thinking about properties that have future value add potential, I mean, that strikes up quite a lot of properties. Not every property would have that value add potential. But we then look at things like location and infrastructure. Could the property over time be used for alternate purposes? And can we do something more? And even for 7 Bullen, this is situated within the Jurong Innovation Precinct. I can mention because there's a Google data center up the road, and when we acquired this property, we had actually another DC operator asked, would we consider converting this into a data center, because it had some power source nearby, but we had a tenant there for remaining 4 years at the time. We also had a life science customer that was working very closely with KWE. They wanted to take up 1 floor, and they were willing to pay a much higher rent, but they needed a lot of power capacity, which we couldn't give them at that point in time as well. And why is that important? Because there is a big advanced manufacturing cluster in this precinct. There's also other logistics and warehouse. There's the Hyundai EV manufacturing hub just across the road.
Yep.
So anyway, the point is we look for those type of things that give us the optionality to do other things. But yes, we are looking at deals. In fact, we're always assessing deals. And we've been pretty close to pulling the trigger in the past, but we've also pulled back. So we find that the deal doesn't meet the requirements, and we're not comfortable in terms of our due diligence. We've gone through, we find there's additional potential costs in the future. We will still shy away from those deals. So even though it's accretive from day one, if I don't see enough provision in the back end, we will not do that deal.
Sure.
Yeah.
Sounds like a great strategy.
And just to answer the second question about EFR, to be honest, we haven't at this moment we haven't contemplated any EFR. That will just depend on the strategy and the execution of what we're doing in that particular year.
Yeah, and certainly you're the buffer since your gearing ratio is 28+% only, right? So
that's right.
So that's a very strong balance sheet there. Okay, moving on to a question on operational efficiencies. So how is AIMS APAC REIT leveraging technology and data analytics to drive operational efficiencies? There's all this news about IoT and all that, cameras or sensors on how much sun we're getting, how much water we're flushing down the toilet. Do you guys leverage analytics to do some of these things that will drive management decisions?
Yes. Okay. So we do. Maybe I can talk through 2 examples. Maybe not really IoT per se, but really a lot of our sustainability initiatives. They use a lot of sensors, and so we didn't talk about it here specifically, but we actually rolled out a smart meter system across the portfolio, and that will allow not only the landlord but also the tenants to track their consumption on a half-hourly basis, so quite accurate. And through that process, we've actually found some discrepancies, right? It's like in terms of there's power going on, but we haven't been backbilling this particular user. So what's happened? And so we've used that information to go and investigate. And so there are also other projects that we've just completed. We've done for 20 Gull, our largest property in the portfolio, we did a pretty sizable lighting system upgrade using LED lighting, using software. to track the capacity, and also if certain users are not in that location, it will just turn off, and that will, and if there's certain unusual sort of usage, that will also alert the particular users. So there's that type of use of technology. We've also, for our term contracts, we're shifting into things like what we call outcome-based contracts, where we work with the contractors who then use technology to help automate and track some of their actual execution of those works. So there is that increased use, but I don't think in terms of IoT specifically, but certainly of sensors and cameras and whatnot.
Cool. All right. And I guess it's a very I mean, this is accepted practice in Australia, right? Sustainability and what's going on over there. Yeah, so that's all great.
That's
okay,
right.
there is a question here that you might have gotten as you interviewed for the CEO position. How do you see AIM's APAC REIT in the next 10 years?
Look, I think that the thing that I really loved about the business is if you look at how we've grown through asset enhancements, redevelopments, and acquisitions, it's really it gives us a very strong foundation, right? And so how do I see the playbook? I would like to continue the current strategy in the sense of growing. We always say growing an asset by asset and step by step. We never like to go and do big portfolio deals and acquire multiple things. We like to just do things progressively and one asset at a time, and we choose that asset and we select the tenant profiles. Because as we think about the structure of the REIT, that's what's given us that resilience. We're trying to add good quality assets to the portfolio every time. So how would I like to see the REIT? Doing much the same as to what we're doing in terms of complementing organic growth that gives us good return on investment with acquisitions, which give us a stronger accretion potential. But I'd like to see maybe the size of the REIT grow from 2.2 billion to maybe 3 to 4 billion. So that would be my long-term objective, to really sort of see whether we can build a portfolio, and that could also be through a combination of working with partners, right? As I mentioned earlier, potentially working with capital partners to grow this business.
And I guess it's it doesn't hurt that your gearing is fairly low, so you've got a strong balance sheet that will help you attain those goals given the economic situation. So that's good. Okay, next question. Okay, coming back to economic situation. So, what are the some of the positive and negative aspects of Trump 2.0 that the REIT has experienced?
Positive and negative.
Yeah.
But the reality is we haven't seen the flow-through impact as of yet from the asset side. I think Joo Lee can probably share a bit more on the capital market strength, but certainly on leasing activity, demand, supply of new projects, we haven't seen a lot of material impact as of yet. Joo Lee, I'll pass this to you.
Yeah, I think on the capital markets, I think my heartbeat beats faster because of a lot of market volatility. Like I mentioned earlier, one good example is where we tapped the perpetuals market in March, 18th of March, we issued 4.7% perpetuals market. Now, before us, there was another REIT who issued 3 years. And then after us, one week after us, there's another REIT who was issuing perpetuals as well, but a higher rate. Then after that, it went silent. The market went silent, right? Because of all the trade tariff that came along the way. So I think all this has created a lot of knee-jerk reaction in the market. Like I say, how does that impact us then? So for us, it will be always on our toes. We always have to monitor the market constantly. So what I do on a daily basis is to look into the FX market as well, because I receive distribution back from Australia on a quarterly basis. For me, it's a daily monitoring of the market. What rate to spot? What is the hedging discount? Things like that. So it becomes, with all these market noises, it has now become part and parcel of my DNA to keep on monitoring the market on a daily basis.
Okay, so So what you're telling me is that not only were you a fixed income banker in your previous life, you're also a forex banker, right?
Yeah, almost.
All right. Cool. Okay, time now is 6 minutes past 8. Maybe I'll just take one more question. Okay, so a little bit of a technical question. Would you be able to quantify the rental premium you can charge for a green or sustainable property in Singapore, Australia, versus I guess a normal property which does not have sustainability, goals and so on and so forth? Is there a premium?
Well, I would say rental rates are determined by multiple factors, typically by market supply. Where's the market at that point in time? Specifications of the asset, location of the building. Certainly, if the property has green features, it's a plus. That might have, I would say, maybe some greater demand. But in terms of having a much higher premium potential, I would say at this point it's not so evident through the rental rate per se. But certainly there will be more, particularly European-based tenants and corporates. They typically, are seeking that type of green features of the property. US at the moment through Donald Trump, I would say it's probably less sought after at the moment. As you know, he's not really a big sort of climate change proponent.
Yeah.
But look, it's certainly, I think from our point of view, it gives us longer term value because you do have the savings from the green features. Anything that is, for example, chiller systems that are energy efficient, rather than spending $100 outgoings, that may reduce to maybe $70 outgoings, and so you have a very short payback period. So it does provide really a benefit in terms of the net property income, which will then sort of filter down to distributions.
Okay.
And also, just to add, I think Russell mentioned earlier, the AEI that we have, 7 Clementi is a Green Mark Gold Plus. That also command higher rental reversion when the tenants come in later part of the FY 2026. So that's one example where we are able to charge a premium on our higher rental reversion when this property or industrial building is upgraded to be a Green Mark Gold Plus certified building.
So just for my understanding, what does Green Mark Gold Plus mean? Is it lower energy consumption?
It's a BCA Green Mark certification. So you go through a list of it's almost like a survey, and basically you've got to achieve a certain energy sort of efficiency and savings in order to attain that certification. And that certification will also get refreshed every 2 years. So as a landlord, you've got to continuously invest in terms of new energy equipment within the building.
Okay. All right. Thank you so much. I think that's all the time that we have for. Big thanks to Russell Ng, CEO, as well as Joo Lee Lim, CFO of AIMS APAC REIT. It was a joy talking to you guys. Very candid, off the cuff comments, at least from my side. Thank you for spending the time with us and answering the questions from all our viewers. So for our members and friends out there, thank you very much for joining us. Hopefully you learned a lot more about the REIT sector as well as AIMS APAC REIT. Certainly something very interesting out there in the marketplace. Very unique REIT given its profile as well as the sector it's in. All right, one more admin matter. There is a QR code here to subscribe to the SIAS mailing list, so a little bit of selling on my part. So if you guys are not on the list, you might just want to take a pic and just subscribe. All right, so thank you very much. Thanks, Russell. Thanks, Joo Lee. Good chat.
Thanks, Benjamin. It was a pleasure.
Thanks.
Thank you.
Thanks all.